Thank you for being with us today for our 2021 economic forecast. We're thrilled to bring the memberships of CCIM Wisconsin, SIOR Wisconsin, and CARW together for this timely event and discussion. I'm Tracy Johnson, for those who I have not yet met. Everything we do is possible because of our members and our gracious sponsors. Our partner sponsor for CARW is Ergens. Ergens is a commercial developer, investor, and operator of commercial office, healthcare, mixed use, and development real estate. Let's hear from them now.
Hi, I'm Steve Palick, Chief Marketing Officer for Ergens. And make no mistake about it, the brokerage community is our lifeline to transactions. And I can't emphasize enough how important that is. Now, as somebody who spent decades as a broker, I think I have a little bit of credibility to share with you that I kind of understand the development community. There's one thing we all share and one thing we don't. When I was a broker, I wasn't willing to take risks. That's what developers do. But what we share as brokers and as developers are rewards. And I assure you, at Ergens, when it comes to the brokerage community, we want to share the rewards of our success.
In addition to Ergens, we are grateful to the many annual sponsors of CARW listed here. Today's program is presented by Tri-City National Bank. Let's hear from them now.
Hello, I'm Ivan Gamboa.
And I'm Brian DiLorenzo.
And on behalf of our 450 colleagues at Tri-City National Bank, we are proud to sponsor CARW's 2021 Economic and Commercial Forecast.
Our bank is proud to be committed to CARW and its members. Through stable and challenging market conditions, Tri-City National Bank has proven to be a safe harbor. So when you're ready to grow, trust the best. We'll make it happen together.
Today's program will run until 2:30 p.m. We will hear first from Secretary Missy Hughes and then our keynote, Casey Conway. We will run until about 2:15 and then have time for questions. Please enter your questions in the chat function and I'll have them served up. We will end promptly at 2:30. Today's session is being recorded and the slides will be shared. Now, it is my honor to introduce Secretary Missy Hughes. Missy, or Melissa Hughes, is Secretary and CEO of WEDC, Wisconsin's lead economic development organization. Before joining WEDC in October of 2019, she was General Counsel and Chief Mission Officer at Organic Valley. Her previous positions include associate attorney at a firm called Holland and Hart, where she practiced in the areas of natural resources, construction litigation, and corporate business transactions. She has been a tremendous partner and advocate for our businesses in this state and for our industry, commercial real estate. We'll hand it over to Missy now.
Great, thank you so much, Tracy, and good afternoon, everybody. I'm gonna forewarn folks that I made the crazy decision in the last few days to add a puppy to my household. And so if you hear a barking in the background, hopefully he'll calm himself down and take a little nap. I think he's sleeping. So I thought for this afternoon, what would be best is to just kind of level set where WEDC has been in the last 9 or 10 months, what we've been working on and what we're thinking about as we head into 2021. So, obviously we've been very focused on the COVID response and the need to be really actively thinking about the economic health of the state while we're also thinking about the public health of the state. And so throughout the course of COVID, we have been actively working to support Wisconsin's businesses, large and small. We have been involved in the deployment of over $240 million worth of CARES Act funding and WEDC funding in the past 10 months, and that's gone to over 50,000 businesses around the state. So, as we saw COVID hit the state and come across, those small businesses were really the first that were impacted. The businesses where you saw gatherings of more than 10 people or 50 people, you know, whether it was a venue or a restaurant. And we really wanted to make sure that we did everything we could for those businesses, because as we see it at WEDC, those businesses are really the fabric of the quality of life in Wisconsin. Those are our main street businesses. They're where you go out and have a drink with friends at night or stop for coffee on Sunday morning. And so we wanted to make sure that, you know, with an eye towards recovery, with an eye towards rebuilding, with an eye towards attracting and retaining businesses, we need to make sure that the quality of life in Wisconsin is really retained. And of course, you know, in supporting those businesses, we're supporting the citizens of Wisconsin. So that was, I think, a pretty incredible lift over the course of the last few months. Just to give you a sense, in a typical year, WEDC does about 300 awards. And by the end of our fiscal year, which was June 30th, we had done over 30,000 awards. So it's really a testament to the team and, you know, the willingness to dive in and help as much as we could in a real time of crisis. And we were able to accomplish that. A couple other things that we did to really support businesses. We were critical in the role of helping businesses navigate the safer at home order. Remember that horrible moment when we were talking about whether businesses were essential or non-essential, and you know, it would be my hope that we never have that conversation again. But where we could, we were helping businesses understand what does the safer at home order mean for them and how should they be responding to it. And then coming out of that, we wanted to provide guidance to businesses so that they understood what their role was as they reopened and what they should be thinking about, their customers and their employees and their community. And by developing these guidances and these guidelines, I think we were able to really provide help to businesses, information to businesses as they moved forward. And you know, we had the Supreme Court order, and on a dime, we turned from being safer at home to being open. And what did that mean for businesses? And, you know, we really took it to heart that these were businesses that had had their lives turned upside down. And, you know, if you can imagine, as I tried to, being a restaurant owner or cafe owner and walking into your business and understanding that all the hard work you've done to, you know, particularly put the tables in a certain place and to have your wait staff flowing through shifts, and all of a sudden, you know, you have to take out tables, you perhaps have to do outdoor dining, all these things. We wanted to be there to support businesses during that time. We also, you know, with an eye towards recovery and moving towards economic health, started the We're All In campaign. And that campaign started as a, hey, we're all in this together. Let's tie public health to economic health. Let's make sure that we understand that in order to have our business community really functioning, we also need to have the public health side of things taken care of. And we slowly worked on that campaign over the course of the summer, keeping a positive message towards moving, you know, towards doing what we all needed to do to get through the virus. And then as we came through into October and November, we really got the sense that folks knew what they were supposed to be doing, right? Make the choice about what you're doing, but that message had been clear. You know, we all know it. You need to social distance and wear masks and all of that. And so we shifted to more of a shop Wisconsin, shop local mindset. And this was really because we knew that during the course of the pandemic, citizens had made choices, had created habits of shopping online or shopping at big box stores. And, you know, while that's all going to keep going, we wanted to remind our citizens that we have all these fantastic local shopping opportunities. And so not only did we have the We're All In campaign reminding folks to shop local, we also launched the Main Street Wisconsin Marketplace, which by the end of the year had over 400 small businesses from all around Wisconsin on an online marketplace. So, you know, for Christmas, you could shop in Ashland and Viroqua and Sturgeon Bay all at the same moment. And so shop local became really shop statewide, but it still really felt shop local, and we're really proud of that. The final thing I would touch on with regard to COVID was in the middle of the year, we were asked by the Wisconsin legislature and the governor to provide a report on the impact of COVID-19 on our industries and our economy. And of course, you know, this was asked for, it was a homework assignment given to us in April. We all hoped that we would be done with the pandemic by the end of June, and of course we weren't. But I think we were able to really provide a good lens on what was happening in the state at that moment with our industries, with our education institutions, our healthcare institutions, all of which were incredibly impacted. And what I really appreciate about the Wisconsin Tomorrow report is it's kind of a moment in time, but I think it will endure to help us remember the lessons and what we were experiencing during the pandemic. A couple other things that we were able to accomplish and what we worked on in 2020 in particular was the Blue Ribbon Commission on Rural Prosperity and standing up the Office of Rural Prosperity. The governor announced that in his State of the State in January of 2020. And while we could have walked away from it, we wanted to make sure that happened coming into this role. Thinking about rural Wisconsin, thinking about the economy in rural Wisconsin was incredibly important to the governor, and he tasked me with that. And so the Blue Ribbon Commission just published their report on rural prosperity in December. And again, it's a really good testament to this moment in time that we're experiencing and this commission's thoughts on what we need to be thinking about as we go forward. Primary of one of the commission's concerns was broadband and access to broadband, which I know, as you think about developing and working in real estate, it's incredibly important. I'm so excited that the governor announced $200 million worth of initiative in his State of the State last night, and he referenced the Wisconsin Tomorrow report and talked about how this is a fixable problem. And so hopefully those resources will be allocated to broadband, which really frees up a lot of the challenges that we're facing. All during 2020, the team kept working on our regular business of attracting businesses, retaining businesses, supporting growing businesses. We had a lot of businesses in Wisconsin that were thriving during this time, whether it was part of our paper industry or folks who were able to pivot and provide PPE or other supplies. Testing was, taken up by some of our companies. And so we really helped to make sure that those businesses were supported. We continued to work on our international work. Right before the pandemic, I was able to go to Mexico on a trade venture. Sam Rickers, my deputy secretary, who's also on the phone or on the line, was able to travel to Europe on a trade venture. And we have jiggered our whole thinking about trade ventures at this point. We have accomplished several virtual trade ventures, which means we're able to set up meetings with other countries, for myself, with other officials, for our businesses, with other businesses, and we're able to do that virtually. And we're building this muscle, and we're really excited about it because we think it's something that we can take forward as we start to have in-person trade ventures again. We will also have always, I think, a virtual component because we're just finding that it's an excellent way to have a quick 1 hour meeting and you don't have to do all the travel. Of course, it doesn't supplant in-person and relationship building, but it is really an opportunity, and we'll continue to do that and provide that to our businesses going forward. So, as we're headed into 2021 and thinking about where we see the economy going, I'm looking forward to hearing what Casey has to say. We have lessons that we learned in the course of 2020 that we really need to carry forward. And while we're doing, our regular work at WEDC, we're also thinking about the lessons that we've learned about what it takes to really have a functioning and strong economy. I mentioned broadband. That's incredibly important for economic development, but also we're looking at things like childcare and healthcare. It's really hard to be a functioning part of the economy if you're worried about whether or not your child is in quality, affordable child care, or your senior that you're concerned about. Do they have access to good senior care? As far as healthcare goes, if you're not healthy, if your health is compromised, not only by the virus, but by, a consistent and persistent condition, it's really hard to participate in the economy. So from an economic development standpoint, it's really important that we're thinking about all of these different factors. And, the umbrella over this whole lesson of COVID-19 is the impacts of this pandemic really amplified and demonstrated the challenges that our communities and businesses and people of color are facing in Wisconsin. And it is a focus of WEDC to understand what those challenges are, what we can be doing, what we can be doing to remove obstacles, to provide access to resources, but also, you know, are we doing something unintentionally that is adding to the problem? And so really a moment of self-reflection for WEDC, as I think it is for everybody, in understanding how do we change the systems that have created where we really saw the mist clear in 2020 and say, oh, we have a problem that we absolutely have to address, again, in order to have a strong economy. And the last thing I will just mention, you know, while there were a lot of challenging lessons learned in 2020, there were also some really positive moments. And seeing how, you know, not only the state, but everyone can pivot on a dime to say, oh, we can work remotely, we can school remotely. And what does that mean for our future? And what does the future of work look like? And how does that all kind of tie together? But just understanding that we have the ability to change and to do it quickly for things that seemed like it would be impossible to do. And we can really look back and say, okay, what do we want to keep and what do we want to let go from those lessons? We innovated like crazy. You know, our businesses were incredibly innovative. And rather than just celebrating, oh, you know, somebody was able to develop a certain type of technology or something, capturing that culture of innovation and understanding what did you have at your business that enabled you to take that risk, to think outside the box, and replicating that kind of that secret sauce that allows for innovation. And then the final thing I'll say is, you know, at WEDC, we learned the value of our flexible structure. We learned that a organization like ours within the government that's able to listen and respond and act based on what we're experiencing in the moment is incredibly important. And, you know, for you all, as you're thinking about your future and thinking about you know, the changes that you've experienced, especially when it comes to commercial real estate and things like that, I want you to be thinking about WEDC and think about that flexibility and think about how we might support you. Think about how we might work together, because we have, you know, for a public entity, we have flexibility. We have opportunities to be thinking together and to be supporting each other. And so I want you to take advantage of that and work with us and have conversations with us about that. So Tracy, I'm happy to take your questions or anyone else's questions. I'm gonna stick around to listen to Casey, but I'm probably gonna just take the questions now that you have in case I have to jump off.
Yes, so I have two questions for you. First, thank you so much for your time and everything that you've done for our state and for our industry, our organization, workforce, et cetera, et cetera. I know that many on the call have been a part of those partnerships, and you have always had an open phone line and been ready and willing to talk about solutions. So a question about, as you work with companies looking to relocate or looking at Wisconsin as a place to do business or a place to start a business, has COVID changed the conversation in terms of what assets and what attributes Wisconsin can bring to the table?
You know, I think both, to be honest, positively and negatively. Let's start with the negative. You know, Wisconsin made a lot of headlines this year, and some of them were not always favorable for what was going on in the state. And it would, I think, be incumbent on all of us to think about how do we stabilize that conversation when it comes to Wisconsin. Businesses want stability. If you're moving to a state, if you're making that, you know, whether you're building and adding on or whether you're actually moving to the state, you want to know that you're moving to a stable environment because it's predictable and you can act on it. So I think it's really important that as we go forward, we collectively kind of think about, you know, what do we need to be doing to make Wisconsin's reputation as strong as it can be. And when I think about what are the positives, we have an opportunity because Wisconsin is really safe. We have, we have no hurricanes, we have no earthquakes, we have a strong work ethic. We have these opportunities where businesses can mitigate some of their risk. And there's, frankly, I'm sitting in Southwest Wisconsin. There's a lot of space. Like there's a lot of pluses that maybe seemed like negatives before, but now we really have an opportunity to attract businesses by saying, we're a place where you can mitigate your risk. We're a place where you can have real stability, reputation not aside, we can fix that. But making sure that businesses understand our ability to provide what they are looking for. And I think, we've had challenges in the past with workforce. And I think we see that we have a real opportunity to bring folks in off the sidelines, and we need to be really focused on that. Whether it is, like I mentioned, folks who are unable to work because of childcare, or taking care of their seniors, or low skilled. We're seeing that the low skilled workers in this moment were the ones who were really impacted. So let's get them the skills so that they can support those businesses that want to come to Wisconsin.
No, that's great. And so my final question is always the action-oriented opportunity here. So as a commercial real estate community, is there anything that we can be doing to work better with your agency, or ideas that we can help create for you as you kind of reestablish, opening of the economy? You've got a lot of systems and processes that you've already kind of worked through. Is there anything that we can help you with?
I think one of the things that I'm really focused on going forward is making sure that we really understand the assets that we have, that we can provide and explain to potential businesses that want to expand or that want to come here. So really understanding, in a particular area, we've got these schools, we've got these opportunities, we've got transportation, we've got logistics, and really being able to be very data driven when we're having conversations with businesses, because I think, a business isn't necessarily going to make their decisions, and I don't believe it's even in the top 3 of things that they're thinking about as far as moving here when it comes to incentives, right? What I can provide for tax credits doesn't compare to when I can talk about the university system in a particular area, or the tech colleges, or the partnerships that other businesses have with the community, or just the communities themselves. So helping us really gather those kind of assets so that then we can leverage them and talk about them and use them to be attraction mechanisms in a really, I think, concrete and detailed way is something that I'm really thinking about. And I think you guys would be poised to help us with that.
Perfect. Well, thank you so much, Secretary Hughes. We appreciate your time and everything you've contributed to this point and everything you've done for our state. And we look forward to working with you moving forward.
Thanks, Tracy. I'm going to actually leave with a question that maybe we can follow up on, you and I, or anyone on your group, which is, I'd really be interested to know what you all are thinking in the new world. In the world where some folks are deciding that remote works, the future of work really plays into what you all are working on. And so, let's schedule some time to talk about that and think about that together.
Great. All right. Well, thank you.
Thank you so much.
All right. So now we're going to turn over to Casey Conway for our 2021 economic forecast. Again, he will speak for about 45 minutes. We'll have time for Q&A at the end, so please bring in your questions. Otherwise, I have like 55 of them to ask. So I'm going to give a quick rundown of Casey. Many of you have met him before. He's been with us in the past. He's the CCIM chief economist since 2017. He's a 35-year veteran of commercial real estate. He was a commercial real estate expert to Fed Chair Bernanke during the last Great Recession in 2005 to 2010. So he's got, I guess, some pretty credible experience to draw upon. And he's the original red shoe economist. He self-describes himself as someone who has made a loan, broke a loan, fixed a loan, regulated a loan, and now helps advise a large CRE audience on commercial real estate trends and conditions. Casey, I'll turn it over to you in about 45 minutes.
Great. Thank you, Tracy. And those of you that are wondering, I do wear red shoes. So all legitimate. Thank you for that. And thank you, Secretary Hughes. It's so refreshing when you're able to have and hear directly from your economic development folks. Without economic development, we don't have jobs, we don't have demand for our commercial real estate. So it really is a symbiotic relationship. And so take her up on her offer to see how you guys can cross collaborate. Many of her points are spot on. I'm going to try to draw out and elaborate on a few of those here. So I'm going to share my screen and jump right into things here. So I was talking with Tracy early on, and I said, you know, how do we characterize 2021? What's our outlook going to be? And I said, I think it's going to be the year of Yogi Berra, when all of the famous Yogi Berraisms finally made sense. I'm going to explain those. At the bottom of the cover slide here, you'll see I have some little elves down there. I write an annual piece called The Naughty and Nice Elves. And the naughty elves are on the left there under the naughty word. Monetary elf and abominable snow elf with 30 hurricane storms. The nice elves were our community banks like your Tri-City National Bank, and supply chain and last mile. So we'll just jump into it. Here's my disclaimer side to protect all of you, Tracy at CARW Wisconsin, CCIM, SIOR, and Secretary Hughes. I probably should have put you guys in there as well, but these are all my crazy ideas. So I had a few opening perspectives that I think are helpful here. One of my favorite resources that I would share with all of you to look at periodically is by Visual Capitalist. They're great at visualizing all kinds of data, and every week they have some new ones. This is one they did right near the end of the year on the 30 cities that have the most value from their aggregate real estate value. So believe it or not, New York, LA, San Francisco, Chicago, and Dallas are still the top 5. But you guys in Wisconsin are sandwiched between 2 of the top 30, between Minneapolis and Chicago. So the influence sphere for you guys in Wisconsin is very real. So that's, I think, an important perspective. The other thing is looking at your top 50 most valuable global brands. So your Secretary Hughes talking about all the things that they're doing, they have done, they continue to do. On the left, it shows, this is a current one for the beginning of the year. The 5 most valuable brands are all technology, 4 on the left, and then Samsung at the top on the right. And so some of you might ask, wait a minute, where's all my most valuable Wisconsin brands? Well, I thought about that for you. And here's the slide. You can go to zippia.com. They keep this updated for every state in the country. And this is the latest on Wisconsin. And just look at the number of, and I just grabbed the top 10 here, the really high value companies and brands that you have in your state, whether it's Johnson Controls, or think of on the retail and supply chain, Kohl's, Menards, Kohler, Ashley Furniture. And if you just took those 10 companies, they account for over 650,000 jobs. Now, you won't hear that kind of respect given in the mainstream media or outside in New York or in southern states, but Wisconsin deserves a lot of respect. So what your economic development folks have done and continue to do. And another one you guys know from this past year is really the preservation of the legacy Miller and now Molson Coors Brewing to keep that and those jobs right there in Milwaukee and Wisconsin. And you can't do that if you don't have things like Secretary Hughes was talking about, if you don't have the workforce, if you don't have the pro-business environment, if you don't have the cost structure. So a lot of those things I'll share in detail that you guys have and should be very appreciative of. The third one is the real heart of our country is what's called middle market, the middle market companies. It's not the startup small business, and it's not the mega global brands. And so there's an entity called the National Center for Middle Markets. It's housed at Ohio State University, so great Midwestern university in location. And they focus on these middle market companies, those that have between 10 million and 100 million in revenue. So for the Secretary Hughes, if you want to know where economic development heaven is, they meet twice a year, and all these middle market companies come together. They talk about where they've outgrown, what their problems are, where they should relocate, where they can find solutions to problems that they're facing, like workforce. And so I thought I'd share with you how well the middle market, this produces about 60% of our jobs in this country. They occupy over half of our commercial real estate and account for half of all new leasing and transaction activity. So on the far left, lower left there, you can see that the middle market companies had really modest decline in revenue through all last year in COVID. It was down just about 3.7% compared to the S&P 500, which set many stock records and closed the year at a record. The S&P 500 companies were down almost 14% in revenue. The next 12 months, these middle market companies expect to grow. They expect to expand by over 2%. So they really are important. So when you focus on your economy, you focus on your state, who's growing, it's that middle market. In the middle there is an important perspective. This is going to be the headwind through the first half of the year and hopefully not in the second half of the year. It's capital investment. And in all the years that they've been doing this survey and study at the National Center for Middle Market Companies, this is the worst that they've ever seen in terms of companies holding cash. It's the purple shaded areas. About 48% plan not to deploy capital. That's not good. And it's because of that uncertainty risk that Secretary Hughes was talking about and how do they work through that. But still 52% do plan to invest. And if you want to know where businesses feel the impact is going to be the most adverse over the next 12 months, it's in two areas: delaying capital investments and disruption of work. Where do we, factories, whether it's offices, all those things, if we're not vaccinated, how do we make all those work? And when you look at business categories across the top, it's business services. How do they continue to be essential in operating? And it's in wholesale and retail trade. And it's also in healthcare, given the effort on the vaccination, the shortage of healthcare workers, the logistics of the distribution. So these are the real headwinds and the friction that we're going to probably face in 2021. Another perspective is we always tend to focus on the headline national GDP numbers. Some Fed districts, like the one I'm at here in Atlanta, they have these things called GDP now. They don't know what they're talking about. They're just incredibly volatile algorithms that are all over the place. They can say 1 month the GDP is going to be negative and the next month it's going to be positive 20 or 30%. Look at GDP translated local to the state and MSA level. These numbers come out about 3 to 6 months after the national numbers because it takes that long to get all the state and MSA data. And this was an interesting perspective from last year, at least through the first part of the year. The states that were most affected by COVID were Nevada and Tennessee. And so why would they be so affected? They're big leisure and travel. Think of Nashville, think of Memphis, think of Las Vegas. They also had major manufacturing or mining activities. So think of Tennessee with 5 automobile manufacturing plants. All of these shut down in April and May and then had to be restarted, and only restarted with 1 shift, and now we're getting back to 2 shifts. The states that were the least impacted, believe it or not, were Utah and Arizona. Wisconsin is somewhere there in the middle, in the low 30% range. So you weren't the worst, you weren't the best, but it really says for all of the headwinds, your leaders, your elected and your political leaders, and all the other issues you had to deal with, you did a pretty good job keeping your GDP functional and not like other states. I'm going to give you an indicator here on slide 8, which I think will be probably one of the most important forward-looking bellwether indicators to tell you about our ability to return to work and whether it's going to be a new normal. And that is Castle Systems is the entity that creates and manages most of our key card and fobs systems that we use to get in and out of buildings, whether it's a warehouse or an office building. And what they're telling us is that only 16.5% of us with those key cards and key fobs are actually going back to our places of work. We're somehow doing work remote. If that number doesn't quickly by the summer get back into the 50% plus range, there is not going to be any of this rosy scenario that we're all forecasting and hoping for in the second half of the year. The vaccination effort is not going well right now. A lot of the governors are confused. They weren't ready for it at the state level. I'll share with you where you guys are at. It's terrible here in the South. Georgia and Alabama and Arkansas are 1, 2, 3 in the worst in terms of actually administering the vaccination. And think about that. Here in Atlanta, we're the Center for Disease Control, and we have the world's busiest so-called airport, and we can't figure out how to vaccinate even 20% of the people for the vaccines that we have. But look at this Castle Systems. They break it down for every state, every city. The best is Dallas and the worst is San Francisco and New York. So this is going to be a good, important forward-looking indicator. The other one, the secretary mentioned about logistics and the importance of that to your economy. I have always tracked transportation metrics, and 2 of them, the legacy one that I've tracked for many, many years is the rail traffic data, because as things go on the rail goes our GDP. And so we saw in April and May our worst months of rail traffic. Everything was shut down. The ports were shut down. Factories were shut down and idled. Supply chain was usually disrupted. Guess what happened in October, November? we had our biggest months ever, not in percentage change, but in absolute real numbers of rail cars and containers moving on the rail. So that's telling us our supply chain is getting back functional. We're able to go to the grocery store now and buy toilet paper. So that's an anecdotal indicator. On the left, though, is the TSA passenger count. Some of you may be familiar with this. It became real in focus in about April when we started to shut down air traffic and travel. And a year ago, we typically saw somewhere around the 2.5 million people going through our airports every day. In April, that collapsed to 85,000. We've worked our way back to an average of about 500,000 to 600,000 a day. It was up over 1 million over the holidays on certain days and weeks, but it settled back into that 500,000 to 700,000 range. Unless this gets back to about 1.5 million to 1.8 million, our airlines are in huge trouble. Our entire leisure and travel industry, our convention business, our ability for business people to travel and have conferences and meetings is in real serious trouble. The airlines need about 1.8 million passengers traveling a day to break even. And so what's happening now is the airlines have gone since the end of September with no additional fiscal support. They're tremendously strained. They're burning through their cash. Southwest and Delta are in the best shape. American and United are in the worst shape. They're trying to do things now by cutting route structures. Cutting route structures is economic suicide. So for your economic leaders and your economic development folks, pay attention to what's happening to the airlines and their route structure cancellations or consolidations. Because if suddenly you can't get to Milwaukee or other cities in Wisconsin very easily, companies begin to not put you on that list for expansion, retention, and new site selection. So pay attention to the transportation metrics. Here's the new American Association of Railroads rail time data. It's a whopping $120 a year. It's the best value in data you'll find. And it breaks it out by every commodity, by different railroads, and by intermodal, which is the containers that move on trucks and rail and shipping containers. All right. Now we're gonna have a little bit of fun on the outlook. I'm going to share with you my annual naughty and nice L's, and we'll start with the naughty L's, and it'll put in perspective the things that have me kind of maybe grumpy about the outlook for at least the first half of the year, and then what's good makes me feel optimistic. So I'm going to start with the ultimate nefarious elf of them all, the monetary elf, the Federal Reserve. So while the Federal Reserve was quick to cut interest rates to zero, it was also doing things like expanding its balance sheet. Remember that the Federal Reserve doesn't manufacture or sell anything. It calls treasury and says print money. So when the Fed expands its balance sheet and talks about that, it's having treasury print money so we can go out into the market and buy certain instruments. And what the Fed was buying was, number one, they said, we're not going to have another housing crisis. We're going to support every mortgage-backed security, whether it's a multifamily loan or a single-family loan. And at the beginning of the pandemic, the Fed had about $500 billion of mortgage-backed securities on its balance sheet. It's exploded that to almost $2.5 trillion. So if you want to know why housing is held up and it's doing so well, it's because the Fed is buying every mortgage it can out there to shore it up and keep rates low. The Fed also was pretty nefarious, where it thought that the corporate America needed a lot of support. So it started buying corporate bonds. Well, guess what they were buying? They were buying Berkshire Hathaway, Walmart, Home Depot. Give me a break. These companies needed no fiscal bond support. Their prices were going up. Their earnings were good. They were able to sell corporate bonds. The margins were great. The Fed needs to focus on the need, which is local and state municipal bonds. Our municipalities, our airport bonds, our convention center bonds. This is where the Fed needs to intercede. And currently, the Fed will not buy bonds in a city or municipality if you have less than 500,000 people in population. So the Fed needs to get to work. Really bad elf. They've said that they took their balance sheet from $3.2 trillion a year ago to over $7 trillion. I believe with now Janet Yellen probably likely to head Treasury, between Powell and Yellen, we're going to see a Fed balance sheet go over $10 trillion. And they never were able to completely unwind it from the Great Recession. This is an experiment we've never tried. We're a fiat currency. That means there's nothing backing our currency, and fiat currencies do fail. The last big one to fail was Germany after World War I. And so we've also had Latin American debt crisis. So we need to pay attention to the Fed, what it's doing. It's way beyond its boundaries of full employment and stable prices. The other one was abominable snowman. This could affect all of us. So we had 30 named storms. The abominable snow elf had to go to Greece during the pandemic to get another alphabet to name all the storms. And what this means is the property and casualty insurance rates are probably going up for all of us. So even though you're not sitting there with Florida coastline or Gulf coastline, your property and casualty insurance rates are going to probably go up as well. And the last time we saw this happen was in Florida after the 2004 to 6 hurricanes. And that's what tipped Florida really into the subprime mortgage crisis, that you couldn't get property and casualty insurance. All the private insurers left. So we have a real challenge ahead of us with property and casualty insurance. Be paying attention to that and know just because you're not on the Florida Gulf Coast doesn't mean it can't affect you. This is a piece I wrote about how severe our public and private debt is. The Councils of Real Estate, which I'm a member, we produce an annual top 10 list. I was the sponsor and author for the number 4 issue, which is the consequences of public and private debt. If you really don't want to sleep some night, or you have a teenager or millennial that you're waiting up on and you need to stay awake and you don't want to partake in coffee and caffeine, read this. It'll keep you awake all night long. It is not a pretty picture as to where we're headed from a fiscal standpoint. I also want you to focus on this fiscal issue from a state and local. It's important for states to understand where their revenue comes from. And in many states, a disproportionate amount of their revenue comes from sales taxes. And if you have lockdown orders and you don't have businesses open, you don't collect sales taxes. And so look at the states that are highest. It's places like Nevada, it's Arizona, it's Tennessee, it's Louisiana, where as much as 40% of their total revenue collections for the state are driven from or derived from sales taxes. And so if you have lockdown orders that have basically shut down most of those states for a third to 50% of the year, they have a huge fiscal problem ahead. In Wisconsin, you're pretty balanced. You have about 20%, so not too terrible. How do state sales taxes, property taxes, income taxes translate overall? On the right, this is a chart. NPR did this piece in conjunction with a number of universities that looked at what was down as we got into this summer. We won't get this new data for about another week, that looked at what percentage of state revenues had declined. And the average was about 29% through the summer. The preliminary numbers are looking that the average for our states is over 40%, approaching 50. Wisconsin, we're down about 22%, so not as bad as the rest of the country. So despite all the disruption and the challenges that you guys had on top of COVID, you did pretty well managing this. But this means your state and local governments are going to have real fiscal holes to fill. And what it means for Secretary Hughes is there's probably not as much money to give away and incentives to attract businesses. So you're going to have to compete on the merits of education, workforce, logistics, transportation networks, all of those other elements, because the fiscal holes are going to prevent most states from having kind of goodie giveaways like what happened with the Amazon HQ2 search about 3 years ago. All right, another name or thing to put on your radar list is bank failures. They're back. I was at the Fed during the 500 that happened during the Great Recession. We had 4 in the second half of last year. My forecast is we'll have over 100 in this year. We're going to rival what we went through during the Great Recession. It'll be much quicker. So far, none of them were in your state. They were in Florida. They were in Texas, Illinois, different places like that. So if you want to know about the health of the banks in your state, in your region, in your city, there's a thing called the Texas ratio. And those of you that are old with gray and thinning hair like me, I'm 58, you'll remember this back from the SNL days. It's still produced today. The Texas ratio is a percentage of a bank's capital or its equity that is restricted because of bad loans. So you want this ratio really low. So 5% or less is considered a bank pretty healthy. You don't have a lot of problem loans. But as it rises above 10 into 20 and 30%, you're at risk for having a visit from the FDIC on a Friday afternoon. And so let's look at the Wisconsin banks here. You're pretty good shape. You've got to get down to State Bank of Cross Plains that's just above 5% to see anybody get above 5%. One of your sponsors here today, Tri-City National Bank, very good, below 3%. So overall, right now, Wisconsin has very healthy banks, especially community and smaller banks. Appreciate your community and smaller banks. They're the ones that stepped up during PPP. They're the ones that are most willing to be front of the line when economic development or someone like Secretary Hughes needs their help. So really patronize and value your community banks. This is a piece I wrote about or had it published on the Texas ratio. If you want to know everything about it, here's the piece in Biz Now. I won't go through it here, but again, this might keep you awake at night if you need to be awake a second night. All right, let's look at some other naughty L's, the lockdown L's. These are the ones, again, it was very different in how it played out. Here in Georgia and in parts of Alabama, you wouldn't know that there was a virus. Traffic is about the same. People are out and about. The first thing that our Georgia governor opened up in May were bowling alleys and tattoo parlors. Give me a break. So it's been very different. And so you may have a very different experience in New York, California, than say many of us in the southern states. And this has really affected what's happened with small business failures. As small business failures occur, we think that we've had about 40% of all small businesses in America have failed. They're gone. What do we do with that real estate? What do we do with those lost jobs and that lost household income? So your economic development partnership with someone like Secretary Hughes is going to be important to us in the real estate industry, because we need to release that space. We need to resell it. We need to repurpose it. And we need that to get back on the property tax rolls as a high paying asset contributing, since you don't have a lot of dependence on sales taxes. The other one is Bob the Builder Elf. Bob the Builder Elf was terrible. And many think I was crazy, saying, wait a minute, housing did great. How can Bob the Builder Elf be terrible? Bob the Builder Elf was jacking up home prices all during COVID, sitting on the beach, fishing and drinking beer, and not building homes or affordable housing. If you look at KB Homes reported its earnings this morning, and it stated that, you know, they did very well. And the reason they did well is they build move up and luxury homes, and they're able to move prices up about 5% almost quarterly. So it's that high end. It's not the affordable. It's not the workforce housing. So a couple perspectives I'll give you here on workforce on the office. This is a survey by KPMG that did at the end of last year. And 70% of CEOs said we're going to continue to downsize office space. They're going to shed urban downtown space, and they're going to do more of a hub and spoke, more smaller suburban offices where teammates can get together and work on projects or meet with clients. So that's not good when the CEOs say we're going to continue downsizing. The next one is tech companies. Tech companies have said more than half of us, we're going to ditch the office. And we've seen that. We're seeing it from West Coast companies. We've seen it from all kinds of tech companies. We saw even retailers like REI not move into their headquarters. They built a brand new headquarters in Washington State this year and put it on the market before they moved into it. So that's not encouraging, because tech occupies a lot of office space. On the housing perspective, I put 4 pictures here. You know, I've gotten really smart as I've gotten, into my late 50s. I figured out how to use my smartphone to take pictures of Bloomberg and CNBC in the morning, so I don't have to make a slide. And so here were 4 slides. The top 2 are what the media and I think a lot of the realtor industry wants you to think about housing. They want you to think about record median high prices and how much your home's going up in value, up 16% since last year, the median home price, over $313,000. No inventory. So, existing home sales, anything comes on the market is going to be soaked up. It's going to keep prices strong. We're not going to have what we had in the great financing and housing recession, where we had all this excess inventory. But that's not the real housing story. The one that scares me and concerns me is at the bottom. We have a mortgage mess on our hands. We have 1 in 4 American households that can't pay their rent, can't pay their mortgage, and are delinquent or in a rent or mortgage forbearance program. And the numbers that came out Friday, 2.74 million households are in a mortgage forbearance program. And many of them will approach in the first quarter of this year the 1-year maximum period for being in mortgage forbearance. Over 5% of all mortgages, another 2.5% to 3% that are delinquent, and then another 10% of all rental homes and apartments are in rent forbearance. We haven't unwound that consequence yet. And what does it mean that 1 in 4 households have no more support mechanism, no rent forbearance, no mortgage forbearance? The foreclosures start. What does that do to those top 2 pictures in terms of median home price and inventory? And we better start thinking about it and understanding how it translates local. So this is how the Fed, the FHFA, is dealing with it. They keep extending the moratoriums. The eviction and foreclosure moratoriums, they've extended at the end of January. I suspect the Biden administration will extend these into May or July of this year. So if you own apartments, you're going to have a hard time figuring out how to deal with this rent forbearance. And my fear is that rent forbearance becomes rent forgiveness. I think we are going to see some sort of means testing that say households that make less than $50,000, their rent forbearance becomes rent forgiveness. What does that do to the property owner and the landlord? We better start thinking about it. If you have multifamily clients or investors that own quadruplexes and duplexes and that have been that they were FHFA loans, Freddie, Fannie, or HUD, they had to give rent forbearance and they got loan forbearance in return. How does all of this unwind? We don't know, and the Fed doesn't have a clue. They're not even thinking through it right now. So this was a great piece that was done by Visual Capitalists, and they said, what does it look like in America when these programs end, and how many Americans are at risk of being evicted and homeless? And the numbers they tallied was over 17 million Americans look at being homeless. And the big states were Texas, California, New York. But think of this, Florida, North Carolina, number 5. The good news for Wisconsin, you're not even on the top fan list here, but around you in Illinois and in Michigan. And what that means is I think markets like Milwaukee are going to be a beneficiary of what happens in Illinois and Chicago in housing. So this is one of those things where you may be the beneficiary on the bad side of an issue on that side of it. So pay attention to this. Here's another one that's frightening. This just came out at the end of the year. 52% of our 18 to 29-year-old adults live at home again. That's the highest percentage ever in US history. It broke even the records back in the 1940s during World War II that hit 48%. It far surpassed what we had in the Great Recession. So when you think about how important it was in the Great Recession to get the millennials out of mom and dad's home, forming households and functioning in the economy, we're at a much greater crisis on that. And you don't hear anybody at the Fed talking about how that's going to work out and unwind. All right, some more naughty L's. University L's. You have some great universities, and Secretary Hughes mentioned to you the importance of higher education. It's one of the pluses that companies look at when they come to your state is workforce in higher education. When I started my career, the University of Wisconsin's graduate real estate program by the late Dr. Graskamp was the unsurpassed program in the country. You have great universities and great schools, but many did a terrible job of dealing with continuing with remote education. I have 2 daughters, ages 20 and 25, one in grad school, one in undergrad, and the performance of remote work and Zoom professors and Zoom exams was atrocious. My undergrad, who had had 2 years of straight A's at the University of Alabama, actually withdrew. It was so bad and doesn't know what she's going to do. My graduate one that's at Florida State University, she's doing a graduate program in arts administration. That's the business side of running venues. They dissolved her program because they don't know what the business is going to be like for running venues and concert halls and all these types of venues. So there's a few exceptions. In Indiana, Purdue University, the 10th consecutive year they've done 0 tuition increases. In fact, the average tuition cost is about $10,000. I tip my hat to them for what they've done in containing costs and figuring out how to keep education accessible and affordable. There's other professors, there's exemptions in CCIM world, Dr. Mark Levine, Dr. Ron Thorpe at the University of Denver. They're the type of the few professors that continue to hold in class attendance and be there to support graduate students in their programs, in undergrads and upper level courses to keep them going. So there are exceptions, but for the most part, the universities figured out how to play football, but they didn't do remote education very well. The other one that we look at here is human resources ELF. They were totally disconnected with what was going on in companies. They didn't pay attention to what was going on with earnings. Companies cut labor like mad while they were making record earnings. The stock market increased by over $5 trillion in equity value this year. Every index set records. Almost every company was up, especially in tech and retail and logistics, yet we cut over 2.3 million jobs. So big disconnect. Shame on human resources, ELF, for not realizing all the money that was made in cutting workforce. In the Midwest, I track for the country, I track the Challenger Gray data every month. This is a breakout of their latest report for December in the Midwest, and you can see Wisconsin's not bad. That Ohio, Minneapolis, Illinois, Michigan, and Missouri were the states that really cut labor. So for Secretary Hughes, a lot of your companies did a good job hanging on to that valuable labor. The next one I want you to pay attention to is Chapter 9 bankruptcy ELF. This is where cities and counties file bankruptcy. And during the Great Recession that I was at the Fed in 2005 to 10, we had over 74 county or municipal bankruptcies. My forecast is we could see over 100 by the middle part of this year. And think about what real estate is worth, how it transacts, how it's financed when you're in bankruptcy and you don't know what your taxes are going to be. And some judge is determining expenses and revenue control. We better be paying attention where you're transacting real estate. Companies have now added in site selection an analysis of the fiscal health of counties and cities before they go in there. So it's not goodies and giveaways, it's workforce, it's stability, it's pro-business environment, it's low cost, low tax, and it's fiscal health of cities and counties. The next one is Hacker Elf. We all know what happened here with the hacks. Did we not learn anything from Equifax? All of us have to take very seriously in our industry and CRE how dependent we are on data and how vulnerable we are to hacking and in our cloud servers. The other two, the Scrooge Elf, this is government. For the most part, whether it was Congress, look at the fiasco we went through at the end of the year to just get a 900 billion package to pick up where we left off at the end of September with the CARES bill. We built a fiscal bridge from March until September, and then we assumed nothing. And so even extended unemployment insurance benefits that would have ended in December, we couldn't even come to agreement. Government really failed us on this side. Taxing Elf, every jurisdiction, every state, every county, every municipality is going to have to look at ways to generate new revenue to fix their fiscal pothole. And so we're going to see a lot happen next year in property tax appeals by hotels and restaurants and retailers. And what are state and local government and school districts going to do with property tax being appealed and coming down? We better start connecting those dots. All right, that's the bad news. Let's pay attention to the nice elves. Number one on my list was supply chain elf. Can you imagine if we didn't have our supply chain act together? And a lot of this happened because of one, technology, and two, the tariffs. The tariffs over the last 2 years in 2018 and 2019 highlighted how vulnerable our supply chain was and how vulnerable we were to certain parts of the world for 100% of things like pharmaceutical, auto parts, electronics. So they did a tremendous job keeping our staples going, our grocery stores going. We couldn't have done remote work. We couldn't have done Zoom work if we couldn't order online and have groceries delivered to the house and have all of that logistics work. And then look at what we had over the holidays. We had Ship Matrix tells us over 3 billion packages were shipped between Thanksgiving and Christmas. That's up over 800 million, almost 50% from a year ago. The next one is Site Selector Elf. This is great news for you, Secretary Hughes. Site selection didn't die or go dormant and in hibernation during COVID. It kept going. And there are a number of notable examples. In little old Birmingham, Alabama, they kept fighting for the World and Police Fire Games in 2025. This is something Wisconsin could win out in the future a few years. They kept it going when others fell aside, and it's a miniature Olympics that will happen. General Motors announced a new electric vehicle plant for Cadillac going to Springfield, Tennessee. That'll be the 6th automobile plant in Tennessee. Navistar announced a new commercial vehicle plant in San Antonio, Texas, because of workforce, technology, the Port of San Antonio, which is all technology. Look at the moves out of California. You're going to see many more leave the Northeast and leave the West Coast, and they're looking for workforce, stability, predictability, affordability, pro-business environment, all the things that Secretary Hughes talked to you about that she's focused on. Look at Epic Games. They just bought a former mall to move their headquarters into in Raleigh, North Carolina. There's some big ones that are coming this year. Fujifilm has an RFP out to look at where they put their technology, manufacturing, and industries plant. The new Space Command headquarters is going to be announced. Does it go Florida, Texas, Huntsville, Alabama, Colorado, California? There are some big site selection opportunities out there. Work with your economic development folks to win a few of those. Here's Site Selection Magazine. If you don't subscribe to it, this is something to partner with Secretary Hughes on. This is their profile. They profile every state. This is a profile on Wisconsin. So, you know, it's not, as the media would portray, horrible, terrible. You're actually in the middle. Some of the areas that you do really well are on like highest education and R&D. That's what companies need. You're number 16 among all states. So you rank pretty well on a lot of areas here. Are there room for improvement? Yes. But would you be able to retain a Miller, Coors, Molson if you didn't have your act together? And the answer would be, of course not. So you're doing a lot right. Continue to work with your economic development folks. Last mile, ELF. So this is how we get our goods from the warehouse and to the last mile at our house. And what we're finding is that's the biggest challenge. It's over half of the cost in all of logistics. So for moving it from the manufacturing plant to the MSA through the warehouses by ship, by rail, by trucking, but then that last mile to your house is the most expensive. It's over half of all costs. So big box retailer, and you have big box retailers that are prominent. Think of those top 10 companies like you got Kohl's and you got Ashley Furniture and Menards. They're trying to figure this out. And what they're figuring out is a new thing called RICS, retail to industrial conversion. And we at CCIM Institute, we were fortunate with our Red Shoe Economist. We just developed the first industry course on last mile, what it really is. And it's not just some trite definition and a few picture examples. It gets into things like, how does retail to industrial conversion work? What is Amazon doing in buying malls or buying Toys R Us stores or former Kmart's and making them their last mile distribution in conjunction with their warehouse? So a lot of neat things happening there. If you're CCIM, look for this free course. It's already started this month if you renewed your dues. The other one is Free Everything ELF. This is the Federal Housing Finance Agency. If they hadn't interceded and provided rent forbearance and mortgage forbearance programs, we would have had a housing crisis worse than what we saw in 2009. So they did the right thing in making sure that people could be at home. We did have an explosion of homeless population, but now we got to unwind those programs. So think about that. Here on logistics, this is a paper I wrote a year and a half ago. We developed our own logistics transformer here on the left. And what it really was about 2 years ago was our economy was changing from a shop and take home to an order online and deliver to me. And what COVID did, it advanced everything by about 5 years. Here's the last mile logistics course that we've just created that's launched right now. This is what it looks like, the cover page. This is that RICS, the retail to industrial conversion. CBRE has started following this. They're tracking about 15.5 million square feet of this. We at Red Shoe Economics are tracking over 100 million square feet of this. It is big time right now. So for all that vacant retail and stuff, it is now a new industrial opportunity. It's economic development. Share your knowledge of retail and industrial with Secretary Hughes to convert these dark retail buildings into something productive again. This is what it looks like. Amazon just did this one in Hampton, Virginia. So it's not a big market. It's not Dallas or Houston or Chicago. This is little Hampton, Virginia. And Amazon's picking these up, a former Kmart. They buy them for around 50 to 60 bucks a square foot. They put $10 a square foot of improvements, new roof with skylights, upgrade the asphalt parking to concrete. And then they put a new Amazon triple net 20-year lease and they sell it as an industrial property, triple net. And what they bought at 50 or 60 bucks a square foot is now worth over 100 and desired by all different types of funds out there. Data ELF, we're all dependent on data. Look at all of the data ELFs that helped us this year, whether it was TREP on loans transferring to special servicing, looking at what's coming your way, Real Capital Analytics and knowing what's happening to prices and cap rates, the American Association of Railroads, the TSA passenger count, CompStack. It's an alternative to CoStar that's tracking what's happening with the leases. So we have a record number of square feet in office right now that are being put on the market for sublease. What are those subleases coming out to be? How much lower is the rent? What are the terms? All of that. CompStack, that's their specialty. Visual Capitalist, Johns Hopkins University, what they've done on COVID, Becker's Hospital Review, which I'll get to in a minute. Industry association ELFs. Think of what the industry associations, including your own Economic Development Association, did for all of us to make sure that we were essential workers, that 1031 exchanges got continued. Think of what NAR, National Association of Realtors, did, the Appraisal Institute, making sure that appraisers could still appraise properties, IREM on closing offices and reopening them and making them touchless, the Counselors of Real Estate with things like the top 10 issues, the CCIM Institute on all the education offerings and being cutting edge, keeping all of our conferences virtual, making them real, breakout rooms. If it weren't for our industry associations, we would have had a very different outlook and performance for us last year. If you aren't a member, think about joining one of these industry associations. If you are, I hope you've renewed because you got your money's worth last year. Okay, so here's some of them. They track what's happening with delinquencies. This is a proxy for where you can see real estate problems develop in the banks. Industrial, multifamily have done pretty well. Multifamily, though, if your loan is in loan forbearance or you have rent forbearance, you're not counted as delinquent yet. So even that rise in multifamily to 3% delinquency is understating what's coming in multifamily. Look at how awful it is in lodging and retail. It's not good. Real Capitalytics told us the property types that performed where the money's going to go is industrial and apartments. Retail was only down 5%. That surprises some people, but think about what's been happening with retail for the past several years. Record retail bankruptcies, record retail store closings. In 2019, we had over 9,000 store closings. When we do the tally on 2020, it's going to be over 12,000 stores that have closed. So this is telling us where the values are in commercial real estate. The exchange out, this is a stock exchange, is not just a package exchange, but the stock exchange, every one of the indices closed the year on the last trading day in record territory, up over $5 trillion in equity value. If you think we're going to repeat that in 2021, talk to me. I don't think we are. I think the stock market can continue to rise. It's going to be more of a picker's market. I think people are too rosy in their forecasts about vaccinations and a change in government. The other, community banker elf. So as opposed to the large banks, the community banks make our economies and our local communities work. They were there doing the PPP program. The large banks didn't do a good job. Things like your Tri-City National Bank, your community banks that have good credit ratios, they all did very well during the Great Recession and pre the housing crisis. They weren't part of the subprime problem like the large banks were. These are very important. If you don't have a community banking relationship, consider one, get to know them. They do a lot for us, and pay attention to the Texas Ratio ELF. This just shows where commercial real estate is concentrated. I'm going to skip past that. Workforce Ls, we probably should have put in here for Miss Hughes, also economic development Ls. If we don't have workforce engaged, productive, efficient, and coming, we don't have demand for our real estate. And it's not just first responders and medical workers. It's the people at our grocery stores, our truckers, our drivers, our restaurants that did open. We owe a huge debt of gratitude, especially those of us that were able to work remote. And the last one is the get or done ELF. A lot got disrupted in 2020, but a lot got done. Look at how well your state performed. Look at how well your real estate performed compared to other areas like Illinois and Michigan. At the beginning of this pandemic, I said, let's look up and forward and also engage in what if thinking. If you don't look up and forward, you'll never see light at the end of the tunnel. And if you don't engage in what if thinking, because whatever you think is going to happen today, I guarantee you by the end of the year, we're going to see a whole different play out of what's going on. So have a plan B, a plan C for what's going on. This is one I'll give you in terms of that what if thinking that could be your most important bellwether metric and data source to look at this year. Becker's Hospital Review puts together how vaccinations are going around the country, state by state. And the top 5 are South Dakota, Connecticut, New Hampshire, North Dakota, and Iowa. They're all able to distribute and inject into people's arms between 50 and almost 70% of the vaccinations they're receiving. Look at who's at the bottom. Alabama, Arizona, Georgia. I think Arkansas and Georgia just flipped between 49 and 50 here over the last 24 hours. Think of that here in Georgia. In Atlanta, we're the center of disease control, and we can't even vaccinate 20% of the doses that we receive. We've got to pay attention to this. Wisconsin, you're in the middle. Obviously, there's room for improvement, but hey, at least you're vaccinating almost double what we're doing here in the Southeast. So we need to see this go. Follow this, and this will tell you how much quicker we're going to get to where we want to be, which is immunity and able to get back opened up. So here's just a quick snapshot of the 8 things that I'm looking at. I have an arrow that's there in the bottom on ESG and impact investing. So ESG, for those who aren't familiar with it, it's environmental and social governance. Before the pandemic, it was all about environmental, reducing carbon footprint, making buildings more efficient, not wasting energy. During COVID, we saw the S part, the social diversity, the social injustice, the social problems that have been building since the Great Recession and what happened with housing. Think about it. Before 2008 and 9, we told everybody that was at the bottom of the workforce scale, they could buy a mortgage, raise their hand, swear they could afford a $500,000 home making $30,000 a year. So they all were happy. They all had housing. And guess what happened? We ripped it all away from them because we gave them phony bad mortgage products. And that whole problem had to play out. It's been building. It's been bubbling. We had a housing crisis going into 2020. it's going to be with us in a bigger way. So pay attention to ESG. Major institutional funds are putting and allocating up to 5% of their capital to what they call impact investing. And what that means is if you have a project, a real estate project or a company or a financing need that deals with an ESG item, could be affordable housing, could be cleaning up a blight area, it could be an education program, it could be a workforce training program, they will almost give you the money for free. They'll reduce IRRs and the cost of the money greatly. Many of them will go to 90 to 100% equity funding, so you don't need debt. It's going to be a big thing in our future the next few years. So I'll close on this. You got to be very careful if you don't know where you are going because you might not get there. I think that was Yogi Berra's most famous one that I think is a good point to look on. Here's the ESG item I want you to pay attention to that's at the end here. Rating agencies now are doing ESG consideration analyses as part of public companies' bond rating. So for your economic development folks, if you're not paying attention to how you as a community, an economic development area, a city, a state, or a county, or your businesses perform on ESG and how well you tell your ESG story, it can affect your bond rating. And not just corporate bond ratings, they're doing this on municipal bond ratings. So I will stop there and see if we have any questions, and hope I didn't go too long.
Thank you, Casey. I have a lot of questions. And thank you so much for your insights and your time. I know I had heard you speak to the CCIM National Group back in, I believe that was April or May. Yeah. So a lot has changed since then. I just want to let everyone know that you can type your question in the chat or send me a text message, and we'll definitely get it out for you. Also, these slides will be shared, and this session is being recorded. I want to go back to that session though from earlier in the year or early last year that you gave to CCIM, and you gave some numbers, and it was kind of a forward-looking prediction on business closures in different sectors. And I want you to listen to those numbers and then let me know how they line up. I heard you mention the small business one, but you had said that we could lose up to 60% of restaurants, 35% of hotels, and 25% of small businesses. Now you said 29% of small businesses actually closed. Can you talk about those other areas and what might be driving that and where we are today?
Yeah, so we've actually, when the numbers come in the next 30 days, we'll see we surpassed all of those. The numbers from the National Federation of Independent Business, Small Business, has told us that 40% of all small businesses have closed. And where they don't pick them up are what are called silent failures. These are small businesses with 10 or less employees. They didn't have a bank loan. They were funding themselves off their 401k or a home equity loan. So when they close and go out of business, the only thing that gets turned off is the utility bill. And there's no bank thing to record. And it doesn't get picked up until February or March of this year, when the Bureau of Labor Statistics trues up all of the business creations and failures. The numbers on restaurants from the National Restaurant Association is we've probably lost half of all of our restaurants. And depending on what happens here, really the next 30 to 90 days in the Biden administration and what they do on fiscal stimulus, that we could easily see that 60 to 70% number. And what we end up with are all franchise restaurants, all your rich local character restaurants. They didn't get much, after the CARES bill ended in September. So very, very serious there. Hotels, about half of all hotels are closed. Only about half are open. If you tried to travel over the holidays, say to Colorado Ski Resort or go to a beach area, most of the hotels that are luxury, they shut them down and they're renovating them. They're using this downtime to renovate them and have them ready to go. Others have just said, we don't know what happens with TSA travel and when people come back and conferences come back. So I think we're going to see huge disruption in cities like Las Vegas, Orlando, Atlanta, New York, big convention cities. And I'm starting to travel again, but where I'm going are drivable and they're different. They're in secondary and tertiary markets. So I've done one at a state park that was for the National Realtors Land Institute. I did another one for SAOR that was at a former hunting plantation in South Carolina. And it was very spaced out and it was great. And we could do things outdoors. And I spoke from a pavilion and part of it zoomed in and maybe 75 attended. We are going to totally rethink how we do conventions and conferences. And we'll have more people attend by opening them up to Zoom and virtual, and we'll create a smaller number that will come in person. People don't want to go back to the big cities and the chaos. They're looking for a different experience. So small business, restaurants, hotels, hopefully I addressed them there, those three.
Well, yeah, and again, I think some of this could play well for a city like Milwaukee that is less congested. It's a little more stable. For a lot of the time, many of our businesses have been open. So, it's a little bit more moderate in that sense. We do have a question from the audience about the data. You seem to have a lot of great places and references for the data. Do you have a source for tracking commercial and or residential loans that would be in forbearance?
So so the two best places on the residential, it's the Mortgage Bankers Association and Black Knight. So Black Knight does a great job, and they break it down in a lot of areas. So Black Knight with a K, Knight, and Mortgage Bankers Association, they do a lot. The NAR does a little bit, but the other one is the Federal Housing Finance Authority, FHFA. They have their own home tracking and home price indicator that goes down to the county level. So very good to look at translating these home appreciation and inventory numbers. The National Association of Home Builders breaks down housing starts and constructions by region and by state. Don't think it's by MSA unless you subscribe to something. On the commercial real estate, TREP is my favorite one. The banks don't let you have it. The Fed, believe it or not, with all these stress tests, you can't roll it all up and see what they're doing. So it's not as transparent, but TREP is your good proxy. And so they look at by property type. In the forward-looking indicator, I look at is loans transferring to special servicer, LTSS. So before a loan's delinquent, before it gets foreclosed and moved on into special servicing, it first gets transferred to the special servicer to see what they can do. And so TREP, TREPP, does a great job by property type, by region, and that's your best proxy for commercial real estate.
Question about all of those properties that have been foreclosed on or are thinking of handing the keys over. You have done a tremendous amount of research on adaptive reuse, and I know you were in Milwaukee 2 years ago, I think.
Yeah, it's great.
What are you seeing outside of maybe JCPenney going to Amazon or things like that on the retail and industrial side? Is there anything that maybe a small restaurant or the first floor of an office building, are you seeing any trends there or anything that we can keep in mind, as we work with clients in our market?
All right, I'm going to give you a big hug for bringing up adaptive reuse. It's my favorite topic after ports and logistics. So a lot is happening. We are seeing the adaptive reuse coming into its own. So I think when I spoke to you guys in Milwaukee and you had that great former department store that had apartments and then some retail and it was shared retail and all that kind of stuff, was great. And then we had dinner across the street. So what we're seeing is adaptive reuse started out as large projects in urban cities that were maybe a blight, they were maybe something historic, and it took someone with philanthropy to want to take it on because you couldn't get bank money. It took a lot of equity. We've now evolved beyond that. And now what we're seeing is that those opportunities are in the suburbs. What do you do with a closed retail, closed restaurant, closed branch bank? And so the smaller properties, I call them daily driver. What do you do with something that's 10,000 square feet, a former furniture showroom? And we're seeing those go last mile. We're seeing them go telemedicine, and we're seeing them go office. We're seeing more malls now being acquired for headquarters and office space. They don't have elevators. They have density. They have escalators. I've got two examples in Cary, North Carolina. Epic Games just bought the former Cary Town Center Mall. They're going to put their headquarters in it. In Atlanta, we have one of our northern suburban malls near Emory University. The university is just acquired and it's going to move into all the former department stores and put their administrative offices in their laboratories. And what that means is a lot of retail has the opportunity to regenerate activity in the area. So if my forecast is our office is going to retail, and that means traffic, that means our restaurants, it means our hotels. And it's more than just, some one big mixed use project that takes a lot of capital. It's small. It could be telemedicine. It could be this retail to industrial conversion. It can be office. We're seeing branch banks become telemedicine vaccination centers, restaurants, everything that we're seeing that can go in there. So we're seeing really adaptive reuse become more nugget sized instead of biggie size. It's becoming nugget sized, and we're seeing it go into the suburbs. So people didn't want to go to the suburbs. Well, that's now where the population and the workforce are going, and so there's a lot more interest in it. We're also seeing adaptive reuse go and take over whole areas. I'm working on our Red Shoe Economics is doing a paper for the South Florida realtors, the Miami realtors, on adaptive reuse from a community standpoint. So areas like Dadeland Mall, Doral area, Wynwood, whole areas, the local leaders have taken on a whole neighborhood, and they're bringing adaptive reuse in an integrated way. Small uses, big uses, transportation networks, dealing with driverless, walkable green space. And so I think we're going to see that is the new trend, is how do we take adaptive reuse into neighborhoods and do an adaptive reuse for a whole area, not just individual properties. So really exciting stuff. Look for that paper. I think I have another one coming out in the RMA. Is it? No, IRM. So IRM, in their journal of property management coming out this month, I did one from a property management perspective. Property management of adaptive reuse is very different from a regular property. Your tenant lease up. You're leasing up to tenants that don't have credit. They don't have as long a credit history. They tend to put more tenant improvements in. They need more capital. They also tend to stay and renew. They don't move out. They like it as part of their image. So there's a lot of issues in property management that are different. So a lot of things happening in adaptive reuse. We could spend a whole day on that one. Let me come back and I'll do a whole day on adaptive reuse. And we'll do it in Wisconsin because you've got some great examples.
We do. And it's interesting that place that you were in before, it was the old Boston store, is now Hub 640, which is a office complex. So I want to ask you about interest rates. It's something that, you know, we focus on a lot in commercial real estate. There's a lot of kind of craziness going on right now, especially as you talk about the Fed and some of the debt. I mean, what should we be looking for in terms of interest rates and tracking in that sense?
Yeah, the Fed's going to be a naughty elf again here in 2021. So everybody thinks the Fed sets interest rates, and they don't. They do it in two ways. They try to. One, they can control short-term interest rates because they control the borrowing that's overnight between banks that sets, you know, the prime lending rate that ticks off of it. But we've had LIBOR. So many people went to LIBOR. LIBOR goes away next year. So what's going to be the new index to do LIBOR short-term and variable financing for construction loans? So they do it that way, and then they do it another way with their balance sheet. So the Fed said, we want to keep housing healthy. And since housing keys off of a 10 or a 30-year bond, and we can't control those, how do we do it? Well, anybody that wants to sell a 10 or 30-year bond or issue a new one, which is the Federal Housing Finance Authority, Freddie and Fannie, we'll just buy it at ridiculous low rates and keep housing going. So the Fed went from $500 billion, $500 trillion of mortgage-backed securities to $2.5 trillion this year. They bought everything in sight. The rest of the world didn't buy this stuff. Banks aren't buying it. They're getting rid of this stuff. So what happens when the Fed quits that intervention? What happens when Treasury says no more printing money, or the market says we're not buying this stuff, which was what they did November 10th before Veterans Day, which was the largest 10-year Treasury auction in our history. And the interest rates on the 10-year went from 70 to 97 basis points. And today they're over 1.1. It's because it's the market that determines the long bond. And who wants 1.1% on a 10-year bond when you know the government is printing money and inflation is coming down the road? So there's a lot of nefarious stuff that goes on. I guess what I would say is borrow like hell right now at these low rates, because I think we're a year to 2 years away from seeing something like we saw in the 1970s, where we really do see inflation set in. We see the adverse consequences of being a fiat currency, printing money. The rest of the world doesn't buy our debt, and we have to raise rates. Let's hope we don't go back to a 21% interest rate by 1981. But I think there's more similarities to what was starting in the 70s with inflation and what will start in here. It might take a couple of years, but I would lock down my affordable interest rates now. And inflation is there. The way the Fed and the Bureau of the CPI and the Bureau of calculated, they change the algorithm all the time. So if housing prices are going down, they weight housing in more in the formula, so it looks like no inflation. When home prices are going up, guess what they do? We're not going to weight housing as much. Let's weight, apparel, because no one's buying apparel right now, and they change it. And so what I do is I have, with my mom's group, I get their receipts, their grocery receipts, and look at what's happening. And what we found is really from April to January, that the things that we bought at the grocery store, whether online or in person, is up about 20%. Go try and buy ground beef or a steak or something other than seafood. Go try to buy things that are in short supply, paper products, cleaning products. They're up 20-25%. Look at car prices, they're up. Look at home prices. KB Homes just said, hey, we're jacking prices up 5% a quarter. We're doing great. We love building expensive homes. We're not going to build any of this affordable stuff. So I think there's a lot of stuff. There's unintended consequences in a day of reckoning coming on interest rates. Don't plan on them being like this into 2022 and 23, like the Fed wants you to think. They're always wrong. They always get it wrong.
The Fed is always wrong. I'm going to remember that one. I want to ask a question about one of your slides, and then I have a final question for you after that. You talked about the Castle indicator on the office key cards and looking at that. It was down from what you would have anticipated at this time. Can you talk about what you think is driving that? And if you think that owners in these office buildings are what kind of strategies are they using to try to bring people back, or are they kind of adapting on the other side to just say, we're going to put together different deals, or, how are they adapting?
Very intuitive question. You get a good big star on that one. So a couple of things. So all of us have some sort of key card or fob. And so Castle is the largest issuer. That's a software that tracks all that. So whether it's a warehouse, industrial, office building, retail building, they're tracking. And they're saying that only 16.5% of us are physically going back to the real estate. That is shocking. And that's even after states reopened and whatnot. And if it's Dallas, it's the best, and San Francisco and New York that are the worst, we have a long way to go. What's driving it is lockdown orders. And what's also driving it is a lack of liability shield insurance for businesses. So if a business opens and they're not immune, and you can say, I got my COVID from you and I'm suing you, that would be one thing that could help our businesses and restaurants reopen, is put it on our businesses to say, we can do this. If we got to all enforce wearing masks or space it out, let us decide that. I kind of happen to be in that camp. I have a lot of faith, whether it's my church that has like double the number of services and we have to get a reservation order to go and sit on the weekend. There's a lot of ways that we can do it right. These lockdown orders have done it. The lack of liability insurance protection to businesses has hurt quite a bit. And what it means, that what companies are doing is they're listening to their workforce, and the workforce is saying, I'm not going back to the office. I can see you anytime. We can have a meeting. You can see that I'm working. You can reach me all day, all times of the day, even at 10 o'clock at night. I'm working probably 20 hours a day. I'm working more in a day than I did when I went to the office or the university. And so the companies are saying that's very efficient. And what companies are doing is they're starting to put their space up for sublet. They're planning that they're not going to renew those leases. And so we have a record number of square feet that are available for sublet right now in this country since we've been tracking sublet space. CBRE just put out a report on that. Real Capital Analytics and others are tracking that. CompStack is looking at the sublease characteristics. So companies are planning. We're not going, the workforce is telling us we're not going to go back. They don't want commutes. They want to get together once or twice during the week, but they want it in a hub and spoke. Have a small office opportunity near my house. Go lease a closed branch bank and we can meet there. Those old 1980 vintage office business parks that were low density and low rise, and we didn't want any of them the last 2 years because we all were going to the city. Those are the hottest things in office right now. I can pull up, I can have a meeting, I don't have an elevator. It's easy to isolate from other tenants. So a lot of strategies, and I think the boom is for the suburbs. I think the suburbs are the big beneficiary. We're reversing what happened after World War II in the 1950s, and we're leaving the cities and we're going back to the burbs. We're not doing this high density, experiential everything. We want a little distance. And the other thing it does is it allows affordability of workforce and housing. So if now I can be in Milwaukee instead of Chicago, I can afford a lot more house, a lot more apartment. Also, if I live in Milwaukee instead of, say, Chicago, my company maybe doesn't have to pay me as much. And there's maybe more available workforce in Quad Cities, Iowa, in, anywhere in Wisconsin. So the employers are finding they can get more skilled workforce in smaller secondary and tertiary markets and pay them less, and it works great. So a lot of strategies, and I don't think any of these dots are being connected yet. And that's why I say the future ain't what it used to be. It's going to be very different. This was a watershed event that's going to change us very dramatically.
Well, and that's so interesting when you talk about connecting the dots and you talk about your proximity to workforce in an office environment or a tech environment where you can work from anywhere. Are you going to choose to be in Milwaukee, or are you going to choose where there are lots of pluses and minuses, or are you going to be in Miami, Florida, where the pluses and minuses are different? So, how does that work for retention and recruitment efforts? So my final question for you is, as you leave us today with a final thought about the one thing or one piece of advice that you would give us in our market as we look towards 2021. You gave us so many great nuggets to think about, but if we could boil it down to one final thought and piece of advice.
Yeah, so I would say go back to that engage in what if thinking. So you're going to hear one group of people that say the sky's falling and another group that say no, all's good and it's going to be great and rosy in the second half of the year. Do your own what if thinking. What if the vaccination effort is slower or more problematic and it goes into next year? What's my business plan to deal with that? What's my strategies with regards to workforce and housing and utilization of the office space? So engage in the what if thinking. And I'd say the other one is whatever you think. I started last year, my presentation started off what I called the pitcher influences. Forget whether the glass is half full or empty. Pay attention to who controls the pitcher at the table and whether that pitcher is full or not. And so what were the things we were talking about last year that was going to fill our economy or our glass up? We were worried about Boeing. We were worried about LIBOR transition, lease accounting, tariffs and trade wars. None of that really mattered compared to the black swan event that hit. We have a change in government, a change in Congress. We have a totally different world. We can't travel like we used to. We have we've sown the seeds for tremendous monetary inflation. Pay attention to what the Fed is doing. The Fed always gets it wrong and screws us up in a big way. Their monetary policy has huge unintended consequences, and I worry about it. I think the beneficiaries are secondary cities and markets, the suburbs, because we're going to go to a less dense model that allows us affordability and broader access to workforce. And I think that's going to be the legacy that we look at, that was the good that came out of COVID, that we discovered secondary states and MSAs. It wasn't all about sunshine or high density and experiential workforce and all of that living. It was more about affordability, access to workforce, stability, because eventually we can drive anywhere, we can get on a plane. So I think it's going to be a very different world. I'd look at those things like the Becker's hospital review on how the vaccination effort's going. I'd look at things like the look at Johns Hopkins to see where the outbreaks are going and not coming down. I'd look at the TSA passenger count. It'll tell us if we don't get back to 1 million people a day or 1.5 million flying by the summer, we're in serious trouble. So there's a lot of good forward indices. Look at the Castle system, whether we really are going back to work, how much office space is going to be for sublet. Look at those transportation index. Those will help you with that what if thinking. Just partake of no bad government data, good private industry data. And as your Secretary Hughes said, engage, cross-pollinate. If we don't have jobs in economic development, you don't have demand for commercial real estate. And in order for her sometimes to get those businesses and opportunities, they need to understand the real estate conditions that you all can bring to them. So it's a great cross-pollination. Look at that National Center for Middle Market. It is economic development heaven. Engage in it, even though maybe you don't like Ohio State for football. They don't like Alabama anymore, but they do a really good job in terms of that middle market. The middle market companies are our future. They lease our space, they hire our jobs, they grow, they become those big global brands. Global brands. Got it.
Thank you so much. I have actually one final question.
Sure.
It's a quick one. Quick question. Super Bowl 55. Any predictions? I know you're in Georgia, but
let's see. I rooted for Kansas City last year. I grew up in Colorado with the Denver Broncos. I was speaking to the Kansas, it was an Outlook breakfast with the Fed, and they had the Kansas City football players 2 weeks before the Super Bowl. And so Mahone was there, and he gave me an autographed hat for my son. So my 10-year-old special needs son thinks it's actually my own football team. So, you know, I just, great story. I love seeing anybody other than, you know, New England or a New York team or a West Coast team. I want to see someone that's, you know, fresh new blood, inland. Tampa Bay is kind of a great story, although they borrowed Tom Brady from New England. But I'm always rooting for someone interior Midwest, an underdog.
Like the Packers. I'm giving you the opportunity to do the right thing here.
There you go. It's a great story. And, you know, now that Alabama won the championship, you could go pick up 3 or 4 of those players. I've told Alabama they got to start playing Sunday football. You can't win 7 national titles and recruit that kind of talent every year unless you're not cheating. I have to believe they're cheating.
Oh, gosh. All right, Casey Conway, the Red Shoe Economist, thank you so much for your insights and your time. Again, our materials will be available after the program. We are grateful to Tri-City National Bank for being the presenting sponsor and all of our partners who contribute to our leadership, our membership, and our organization. Thank you.
Take care.
Thanks.